Today, on XRP Daily Brief, we take a deep dive into the current state of the XRP market, the macroeconomic forces shaping global liquidity, the growing pressure on traditional banking systems, and why many indicators continue to support a potential move toward $7 to $10 in the upcoming cycle. While the market has been experiencing consolidation, the broader picture reveals powerful dynamics at work. Around the world, central banks are struggling to control inflation while managing increasing stress within the bond markets, particularly in Japan, where rising interest rates have led to unprecedented unrealized losses on bank balance sheets. Japanese regional banks are reporting losses on domestic government bond holdings at record levels, and similar patterns are emerging in the United States, where commercial banks hold hundreds of billions of dollars in unrealized losses as well. These pressures limit how far central banks can continue tightening monetary policy and historically lead to a renewed phase of quantitative easing, which has consistently driven liquidity into hard assets, precious metals, and digital assets with strong real-world utility. As these macro forces build, something equally important is happening within the XRP ecosystem itself. Increasing amounts of XRP are being removed from the liquid market. Recently, Firelight went live and immediately reached its first deposit cap of 25 million XRP, entirely through organic demand. This marks a significant moment for the Flare ecosystem, where FXRP can now be deployed in liquidity pools, lending strategies, and yield-generating products. At the same time, XRP ETFs have begun gaining meaningful traction, recording nearly $30 million in daily trading volume, which results in additional XRP being locked behind these ETF products. When we combine the growing DeFi activity, ETF-based reserves, digital asset treasury strategies, and the long-term storage habits of retail holders, it becomes clear that a large portion of the total XRP supply is effectively off the market. What matters now is not the total supply of 100 billion tokens, nor even the circulating supply of roughly 60 billion, but rather the much smaller float that is truly available on exchanges. Some estimates suggest only a few billion XRP remain actively liquid, which creates ideal conditions for a future supply shock as institutional demand grows. In addition to supply dynamics, sentiment analysis provides another important clue about market behavior. According to social and sentiment data, XRP has been experiencing its highest levels of fear, uncertainty, and doubt since late 2021. Historically, this level of extreme fear has often preceded significant short-term rebounds. The last time sentiment dropped this low, XRP rallied more than 20% within a matter of days. Markets tend to follow a repeatable psychological pattern. Retail investors capitulate near local bottoms, creating ideal entry opportunities for those who remain focused on the bigger picture. On the technical side, current price action places XRP directly at a critical decision point. Analysts who specialize in Elliott wave modeling have outlined two main scenarios. In the bullish scenario, the $2.04 support level holds, allowing XRP to push back above $2.41 and then $2.65, forming a new upward wave structure that would strongly indicate the macro low is already behind us. From there, the next projected targets fall squarely in the $7 to $10 range. In the alternative scenario, XRP could break below the current support and retest the deeper macro Fibonacci retracement around $1.64 before beginning a larger wave, 3 expansion to the upside. The important point is that both scenarios ultimately lead to a continuation of the larger bullish structure, supporting the thesis of significantly higher prices over the next cycle. Beyond traditional technicals, the long-term timing cycles provide additional insights. The classic 4-year Bitcoin cycle has already been disrupted. Bitcoin set a new all-time high before its most recent halving, something that had never occurred before. This shift was driven by institutional demand through ETFs. XRP is experiencing a similar structural transformation through its own ETF momentum, DEFI expansion, institutional adoption, and upcoming regulatory developments. The broader liquidity cycles, including the century-old Benner cycle, point toward 2026 as a major peak in valuations across multiple asset classes. When we overlay these long-term cycles with the current state of global monetary policy, increasing liquidity pressures, and the rapid evolution of digital asset infrastructure, we see a convergence of factors forming a powerful macro setup for assets like XRP. Ultimately, the present moment appears to be a rare window. Whether XRP rebounds directly from the current $2 zone or briefly dips into the $1.60 range, the overarching structure remains intact and continues to support the expectation of new highs into 2026. Periods dominated by fear and capitulation have historically offered some of the most advantageous long-term accumulation opportunities. For newcomers, this may be one of the final chances to build a position before the next major expansion. For existing holders, it is a reminder to zoom out and stay focused on fundamentals rather than day-to-day volatility. The combination of decreasing real supply, increasing institutional interest, macroeconomic liquidity cycles, and technological growth within the XRP ecosystem all contribute to a compelling long-term outlook. Thank you for watching XRP Daily Brief. Let me know in the comments where you have your next buy orders set and whether you are taking advantage of the current market conditions. If you found this analysis valuable, make sure to like, subscribe, and share to support the channel. More updates on XRP, global markets, and digital asset infrastructure are on the way. This is XRP Daily Brief, and I'll see you in the next episode.